Guys, in this video, I'm going to break down how you can maximize your returns on a trade without ever touching your stop loss. Well, in today's lesson, you're going to learn why moving your stop loss is self-sabotage, the real way to stretch your risk to reward, and how to approach your trades like a sniper, not a gambler. Now, I'm going to be very candid with you in this video because traders are constantly saying, I want more profits. I need more profits. I need to pass my challenge. But then they start pushing their stop loss further and further away, micromanaging their trades, and then wonder why they end up blowing the account. Now, just remember, guys, you don't get paid for being greedy. You get paid for being precise. So I'm going to show how you can secure bigger profits the smart way. Now, I'm going to share with you an example here on pound yen. And this is a trade you could have taken today if you trade in the 2CT entry model. And it's a pretty decent trade. Here on the lower time frame, we're looking here on the 15-minute and 1-minute structure. Okay, now you can see we have a very strong close here around 7:30. So this is pre-London, before obviously London opens at 8 p.m. And with this big close, you can see that we have a very strong close prior to the previous 5 candles. We have an area in the market where price was trapped within these structural highs. And then we finally get a break above this area, which is an indication to us that there is strong volume in the market. Now, based on the 2CT concept, what we're looking for here is for price to retrace 50% or less of the previous candle. And then we're looking for price to flip bullish and then continue bullish. Now, as you can see, when we take a trade, we do not know what direction the market's going. We're anticipating price to continue in this direction because of the volume that is in the market. Now, if we take a look at Euro Yen over here and we go down to the 15-minute time frame, we're looking for synchronization in the market. So here at 7:30, we have a bullish candle close. So this is a strong indicator that there is volume in the market, there are signs of yen weakness, and there is a strong chance that if we're trading pound JPY, that price will continue in that direction. Now, not only that, if I put my cursor around this area where price came back to the 50% retracement, and you look up here on the 4-hour time frame, you will see around this same area we have a bullish 4H candle. Now, what does that mean? Well, we already have higher time frames influencing this directional bias. We have synchronization in the market by looking at Euro Yen. We have a strong 15-minute candle close, which is indicating to us strong volume in the market. And now we're anticipating price to retrace to create a bottom wick, which is the development or the anatomy development of a candle formation, which is wick first, then body next. So that being said, what we're then looking for when we scale down to our lower time frames, in this instance, we're looking at the 15-minute, 1-minute combo. You can see here on the 1-minute time frame that we have a clear directional bias. Price is pushing bullish. We're making high highs and higher lows. Now, as this candle opens, you can see that price pushes bullish, indicating this bullish sentiment. And then we have a retracement, creating a higher low. Now, if we look at the trend line here, you can see clearly that price is respecting this structure. So we have a higher low. We have price coming back to respect this trend line. And again, we have price coming back here to respect this trend line. So we have many confluences in the market. And just remember here, guys, a confluence is just adding confidence to the trade idea. So now that being said, we have an A plus setup. Now, what we want to be doing is we first want to be respecting our risk. Now, before you talk about how much you want to make in the markets, you got to ask yourself this one question. How much am I willing to lose? Because most traders sabotage themselves before they even enter a trade, right? They widen their stop loss thinking that it gives it more room to breathe, but really they're just protecting their ego and not their capital. So your stop loss is not a suggestion, guys. It's a line in the sand. You've got to set your stop loss, you've got to respect it, and you've got to walk away. Now, in order for us to have confidence in taking our trades and look for our targets, we've got to know what we're looking at, where price could be going. So that being said, if I'm using the higher time frame in this instance, which is the 4H, I can see that this 4H candle is currently bullish when I'm planning to enter this buy on pound JPY. I can see that we have an area in the market where price has previously created a wick rejection and failed, but I also see an area in the market where price has created a high in recent times where price can come back to. So now I've got it locked in that this is an area in the market that I can target. So once I have that, I have clear directional bias. Now I'm looking at the structure of the market is clearly illustrating that the sentiment of the market is bullish. We are clearly respecting this trend line, making high highs and higher lows. The new 15-minute candle has opened, created a new high, and pulled back to make a higher low. And when it comes to structural trading, guys, especially when it's just simply trading with a trend, we know price makes a higher low in anticipation of a break of that higher low to then make a new higher high. So it's just very simple trend trading. So if I'm looking to trade this, I can look for the first signs of that bullish shift, which is this previous candle close here. And I can put my stop loss below the structure to target these structural highs. So here in this instance, we have a 3.7R or 3.79R risk reward ratio. Now, the second thing you've got to understand is that bigger profits come from better targets, not bigger risk. So if you want to make more, the answer isn't increasing your risk. It's letting your trades breathe towards the correct higher time frame levels. So you want to be targeting 1 to 3s, 1 to 4s, 1 to 5s, because it's possible, right? But not if you're micromanaging every single pip. So you want to zoom out to the higher time frames as we have here on the 4H, and you want to target structure, right? You want to be holding the positions if the setup is valid. Because remember, when you're doing your challenges and your verifications, you're not here for base hits. You're here for precision home runs. And those come from conviction, not chasing. So when we're taking this trade, the stop loss may seem tight in this instance, but what we're doing here is we're respecting structure, which simply means that if price makes a higher high and higher low in this sequence, then we anticipate price to trade above this level, continue to push higher to make a new higher high. Now, in terms of targets, we never know if we're going to hit them. That is something that we have zero control of. But we don't trade based on certainty. We trade based on having an edge in the market. And that edge simply means that if we have favorable risk to reward back to the upside, then this means that this is a viable trade as long as our confluences line up. And in this instance, we have a nice bullish candle close in anticipation for price to continue bullish. We have a 50% retracement, which is a pattern that we trade as part of the 2CT concept. On entry of this trade, as you can see here, we have a 4H bullish candle. And what we anticipate is once price is bullish, we will close bullish because every single day a candle will close bullish or bearish at some point. Never do you ever see, very rarely, a candle close sideways. So we trust the analysis and the higher time frame bias that price is going to continue to push bullish. So the next thing you have to understand is that you've got to let the markets do the work. And this is key. Your job ends when the trade is placed, right? The market's job begins, in theory, right? When you start dragging your stop loss, adjusting mid-trade, hoping it comes back, hoping it continues to push more, you stop being a trader and you've become a passenger to your own emotions. So if you want to be a professional trader, you don't want to babysit, right? You've got to just execute and observe. And if your entry, your stop, and your target are all mapped out, which they are in this instance, then the work is already done. Now you've got to let the trade play out. Now, some of you might be saying to yourselves, well, I don't need 3.79R because every time I take a trade, price pushes to 3R and reverses on me, or price pushes to 2R and reverses on me. Well, what you're saying is maybe true, okay, especially if your data backs that up. And yes, you may not need a 3.79R risk to reward trade or more than that. Let's say now you're on a challenge, you need 8% to pass that challenge, and you want to pass the challenge, let's just say as an example, in 4 weeks. Well, in theory, if we do the maths, 2R times 4 is 8R, right? So you only need to be targeting 2R. If that's the case, then do you really need a 12 pip stop loss? Well, the answer is no. You could, in theory, give your trade a little bit more breathing room and you can place your stop loss lower, meaning that you still target favorable risk to reward. You also target your weekly target. And if you do this consistently, of course, there's going to be losses, but that is inevitable. Then, in theory, based on the maths, this target of 2R per week over a period of 4 weeks' time will give you, or at least, pass your challenge phase. Then, if you do this when you're trading the verification, which is 5%, in theory, you should pass your verification in 2.5 weeks. Now, whether this happens exactly how it's mapped out is besides the point. You always want to lock this in within your belief system because this will be the catalyst as to why you can continue to show up every single day and continue to execute without hesitation, especially when your trade lines up as beautiful as this one. Now, let's say, you know what, I don't go for 2R targets. My plan of action is to go for more, but I do want a bigger stop loss. But all you have to do, guys, is very simply, instead of messing around with your trades or risking more, is you say to yourself, well, this is going to be the first area in the market where I'm going to look for my management. So that being said, I'm in the trade, the price is pushed in my direction. I'm only up 2R in this trade, but I am targeting more. But what I'm going to do to make sure that I can ensure favorable risk to reward and make sure that my edge is strong in the market is once price gets to this level, which is the area in the market where we expect price to react from, I can use a trailing stop to then manage my trade so that I secure some profits. If price comes back to stop me out, all is good. I don't lose the whole 2R. I do gain something from the market. And then my next plan of action is to say, well, once price breaks above this area, as it is pushing bullish, so we anticipate to close bullish, I can then target a new structural high. And as you can see here, we have an area in the market where price has previously made a new high in past history. And I say past history, this is still recent, but you can see here, this is where we can anticipate price to go to. So that being said, we have management with a trailing stop, and now we have new targets to go for, which is these structural highs. Now, again, this is a 4.48R return on investment, which is very big, and you don't need to target this. But let's just say, as an example, we have this as a roadmap because if price does break above this high, and everything is a if, by the way, in trading, if it does break this high, then this is where we can anticipate price to go to because there is nothing that is stopping this trade continuing higher. Now, you could argue that there is an area in the market where price could find some resistance, which is this wick rejection zone. So that's fine. You can use this as well. Let's say you want to target something smaller. Then we have a very favorable trade here, which is a 3R return on investment. And this is how you want to be trading, right? You got to track the data, not the drama. And that's the next thing, right? You want to gain confidence in your setups, well, then you got to stop reacting emotionally. You got to start tracking the results of the trades where you held to your original stop, you let your targets get hit, and you didn't interfere. And then you're going to start to realize the problem was never your risk to reward. It was never your system. It was your reaction to uncertainty. So, yes, we're in this trade and we're up whatever the return is on this one. But all I'm saying to you is this: don't fear that price will come back and take you out. Continue to hold this trade with full conviction that price will get to your targets because it will. It's inevitable. And here's the truth. Let's say you are going for a 3.4R target. And to make the maths easier for me, let's say you're going for a 3R target. If you lose 3 trades in a row and win one, then guess what? You're a break-even trader. That's massive. And just as you believe you can have consecutive losses in a row, you can also have consecutive wins in a row. And as long as you're only losing 1R and always winning 2, 3, 4, 5R, then your edge is going to do the work for you. And that is where you got to trust him. Because here's the truth: most traders don't want to hear, right? You're not underperforming because of your strategy. You're underperforming because you keep changing the plan mid-flight. So next time you trade, map your stop loss, guys. Define your targets, enter with conviction, and don't touch a thing, right? You don't need to wish for bigger profits. You just need to hold your winners long enough to collect your profits. So if this helped you guys, please just drop a like for me, subscribe, turn on notifications, and just let me know in the comments. how things are going for you. Are you letting your trades breathe, or are you suffocating your own edge? As I always say, guys, continue to trust the process.